I spend about the first 60 days of every year talking a little bit about what we saw from the Dallas real estate market in the previous year, and then offering some thoughts on where we're going in the months ahead. How many of you are less than 2 years in the industry? Show of hands. And I know with the tremendous growth in this office, we've got a lot of people who are new to the industry. On the other side, how many of you have been in the business, say, longer than 10 years? Okay, not as many, but there are a few. That's one of the things that makes this a really good office. You've got a good mix. You've got the grizzled veterans who have seen it all, done it all, experienced it all, and we've got the new blood with the fresh ideas. The people who have been in the business a few years understand precisely what I'm talking about when I say that we have gone through one of the most amazing cycles that any housing market anywhere has ever seen. And one of the ways that you can kind of measure the relative health or the status of our market is to take a look at the writings of a gentleman named Steve Brown. Who knows who Steve Brown is? A few of you do. All of you should. Steve Brown is the beat reporter for the Dallas Morning News. You go to the business section and you will see Steve's picture there, and he will talk to you a little bit about what the housing market has done. Now, Steve is a lot like most reporters and news people. He's happy when the news is really lousy. And if you think about it, you watch television, how often do they break into your programming with a sunshine alert? Have you ever been watching something and had them break in to report a random act of human kindness over in Tarrant County? They don't do that, do they? Bad news is what sells in the media. And so for Steve Brown, bad news is exactly what it is he wants. In 2006 and 2007, when our market was at its previous high, these were tough times for Steve. There wasn't a whole lot of negative that he could write about. But then the crash came in 2008. Those were good times for Steve. And the basic theme of every column he wrote was the end is near, get out of real estate, go back to telecom. There's no point in doing any more of this. 2009 and 10, he was a little more emphatic. His message basically every month was, every one of you are doomed. Picture it said like the Scooby-Doo villain. That sort of thing. 2011, more of the same. As the market continued to kind of swirl around on the bottom, Steve was telling us all, get out, turn back. But then finally in 2012, we finally started to see the first stirrings of a comeback. We began to see a little bit of activity here in the Metroplex, and Steve had to acknowledge, well, you know, gosh, maybe this isn't as bad as I thought it was. Then in 13 and 14, we had two really strong years for the market, and Steve had to acknowledge, you know, this may be the best market we've ever seen. In 2015, he had to admit that it was, because the market had really full-scale come back by then. Now, last year, 2016, Steve got some bad news to write about. A bunch of Yankees up in New England started this theory that properties in the Metroplex were overvalued. And the reason that they were overvalued is because of low oil prices, which were going to destroy the North Texas regional economy. Y'all remember the North Texas regional economy being destroyed last year by low oil prices? That's the problem. There are lots of people who have opined on the health of our regional economy and our housing market who don't really know any more about Dallas than what they picked up having watched reruns with Larry Hagman 30 years ago. And those are the same people who were predicting that we were going to have a tough year last year, but it did give Steve a little something to write about. This year we've come full circle. On December 28th, making his predictions for the coming year, Steve Brown finally had some bad news again. He wrote, and I quote, for the second year in a row, my biggest worry is the white-hot Dallas housing market. Basically, Steve is operating under the theory of things have been so good here for so long that the market, to paraphrase Cole Porter, is too hot not to cool down. So Steve is predicting it's going to be a tough year. We all have much to worry about. How are all of you feeling now that we're a month in? Are we worried? Yeah, I don't think we are. I think we're cautiously optimistic. I don't think we're worried. Should we be? Well, that's what we're going to talk about. But before we do, I want to start by reviewing the projections that we made for 2016. When I was in this office a year ago and we talked about what to expect out of last year, here are the things that we threw out there for you, and I'm giving you some of mine and some of everybody else's. The first thing, and most of us were pretty consistent on this, the expectation was that transaction volume, the number of sales of pre-owned homes in the Metroplex, would probably be flat, maybe up a little bit, but not up much. And the big reasons we thought transaction volume would stay flat were, first of all, as everyone knows, there's not a darn bit of inventory out there anywhere. So if there are no homes for sale, how can we sell more homes, right? But the second concern that a lot of people had is with prices rising as they have, that basically buyers would be priced out of the market. So for that reason, a lot of people thought transaction volume would stay flat. Most of us recognized that we would see a significant increase in dollar volume. What sales did close would close for a higher dollar volume. quite obviously because prices have been going up and almost in double digits going up for each of the last 3 or 4 years. And if you're thinking about it in purely self-interested and pragmatic terms, that's the good news for us in this industry. We make our 3% off the sale price of what closes, right? So we like that number going up, don't we? So we were happy with the idea of prices going up and the increase in the dollar volume. What we didn't know was how much prices would go up. And here the estimates were kind of all over the map. One that was given probably the most play last year came from Jonathan Smoke. Mr. Smoke is the head economist at Realtor.com. His prediction was that price increases, which had been about 9, 10, 11%, were going to slow into the 4 to 6% range last year. Why did Jonathan think price increases were going to slow? Because we were going to get this huge glut of new listings in the middle of the year. Any of you see that glut of listings in the middle of the year? Yeah, I didn't either, bottom line. And then of course there were a lot of other people saying that the low oil prices would wreck our economy, and you heard other ridiculous predictions, but the bottom line. And I will give credit to my 12-year-old daughter, by the way, for the unicorn clip art. Like I said, I'm really bad with computers. Mary Kate's pretty good at it, so she spruced this up for me. She chose that particular unicorn, she says, because it represents the optimal mix of undeniable cuteness and totally cheesiness. So, there you go. But bottom line, we saw flat transaction volume, higher dollar volume, price increases were supposed to slow. I, for one, wasn't buying in on that, but that's generally what we were told. So, against that backdrop, what did we get last year? Well, once more, our market pretty much just totally rocked it. As I stand here today, for the 4th year in a row, I can tell you that we are coming off the best year in the history of the Dallas-Fort Worth housing market. One other little point to consider. As we sit here today, the total value of all residential property in the Metroplex stands at $457 billion. That is a staggering amount of money. That is more than like the gross domestic product of a lot of South American countries. And it is also up 11.1% from last year. So we are very well situated. We are in the middle of a Metroplex that is rife with valuable real estate, and we are the people who facilitate these transactions. It's an awfully nice sandbox to be playing in. The second point to consider is that Freddie Mac, the government mortgage entity, ranks the Dallas-Fort Worth Metroplex as the #1 housing market in the United States. This was taken from an article that ran in the Dallas Morning News back after Christmas but before New Year's. The methodology was a little fuzzy. In fact, it reads with the clarity of one of my Uncle Mike's LSD trips from the 70s. But if you read the article carefully, what you figure out is they are measuring performance of the housing markets in the country from the bottom, when everything had collapsed about 2009 or so, which markets have done the best since that point in time in terms of getting back value, but they're also factoring in what these markets have left as a ceiling, how much potential there is for price growth before things get really scary. And using those two metrics basically, however they're articulated, Freddie Mac says that we are in the best housing market in the country. So we're on a hot streak that continues. We're sitting on nearly $500 billion in real property, and we've still got room for prices to go up. It's a good place to be, probably better than being a realtor in Scranton, Pennsylvania, for example. Last year, total sales for the Metroplex, a new record, 101,529. In 2016, or 2015 rather, we'd done close to 94,000. And everybody went through the year thinking, will we break that magical 100,000 mark? Not only did we break it, we absolutely clobbered it. That's the most homes we've ever seen sold here in the Metroplex. Dollar volume for the year. In 2015 rather, we were at $25.3 billion. Last year, a new record, $28.13 billion worth of transactions, pre-owned homes closed in the Metroplex. And Jonathan, the 4 to 6% price increases we thought we were going to get, nowhere near that, quite a bit higher. Thanks for playing though, Jonathan. Here's your box of Rice-A-Roni. Let's talk a little more about what the market did last year. Looking at it by county. Dallas County, your total sales, 25,311. That's a 3.3% increase over the prior year. Dollar volume, $7.83 billion. That's almost a 10% increase over 2015. Looking at Collin County, we didn't have a big jump in terms of the number of sales. 15,900, didn't quite break the 16,000 mark, but that's a 1.3% better than 2015. But dollar volume, a 9.4% jump. So that tells you prices went up in Collin County. More on that in a bit. Denton County, a lot of you in this room already know Denton County is one of the hotter zones in all of the Metroplex, and it continues to be so. 5.7% jump in sales, but dollar volume, look at that, up almost 14% last year. So that tells us that prices in Denton County did what last year? Yeah, they did. So let's talk a little bit about this. Why is Denton County such a hot sector for us right now? What's driving that? Can anybody articulate it? Relo is part of it. A lot of people are just heading in there. Land is part of it as well. But the biggest driver right now is Denton County is the last spot on this side of the Metroplex where you're going to find homes that are affordable for first-time home buyers or the trade-up buyers. Think back, if you will, about 10 years or so ago. If you were a family of four, you know, maybe a teacher and a firefighter with a couple little kids, and you were looking to buy that first house, a lot of people would go to Plano or they would go to Frisco. There was plenty available for them. Bit by bit, the inventory went away, and what was left, the prices went up, so people moved on, and they looked in places like Wiley or Saxe or Rowlett. Garland, they're still looking there, Richardson. And when that was gone, they turned their guns on Denton County. So the Colony, for example, has had several good years in a row. Parts of Carrollton have fared very well in the recent upturn, and now they're all moving up and down that 380 corridor. They're going to Little Elm and Providence and Savannah, and so right now Denton County is really hot. There are a lot of fistfights over there because there is still some inventory at under 300,000, but that is just an example of what has made Denton County so very hot. When we talk about how the year ends, that's really a significant indicator of what the data is going to look like. There seems to be kind of an old meme, an old bromide, that in real estate everything kind of slows down in the fourth quarter. It really hasn't been like that in Dallas proper for 4 of the last 5 years. We have had very busy fourth quarters. 2016, no exception. Sales in November up 26% over November of 2015, an almost unheard of increase. And in December, we finished 8% better. So those 2 strong months to close out the year are how we got over 100,000 units closed and how we set that new record with over 28 billion. So a little more fun with the numbers here as we look at what happened in 2016. First off, median sale price. We talked about how prices went up last year. Once again, double-digit increases. The Netris reporting region median sale price is at about $232,000. That is a 10% increase over 2015. That's coming on the heels of 3 other prior years of 9 or 10%. Your median sale price in Dallas County, $208,000. That is an 11% jump. In Collin County, it went up 8.7%, and in Denton County, up 8.1%. Tarrant County is a big reason that we got the double-digit final number. Your average sale price in Dallas County, $309,500, up 6.1%, up 8% in Collin County, and up almost 8% in Denton County as well. Housing prices today in the Metroplex are remarkably well situated. Usually when we like to talk about the delta and how much price appreciation we've had, how much value we've gotten back, we usually start by comparing the market now to where it was at the bottom, like around 2009-10, when prices had really bottomed out. That comparison doesn't even make sense. The fact is, we are now 40% higher as a matter of median sale price than we were at the previous top of the market in 2007. So you go back to 2007 where we were setting the prior record, we're 40% better than that. Having come through the valley of 9, 10, and 11, we have gained 40% in the last 4 years. We got our value back faster than just about every market in the country, and we continue to head in the right direction. How many of you are familiar with the Case-Shiller report, or have you even heard of it? Few hands. This is a measure that you all need to pay attention to. You can usually find it talked about in Steve Brown's column in the Dallas Morning News. Case-Shiller is an organization that tracks housing prices in the largest housing markets in the United States. Back in 2009, 2010, 11, when we were struggling, reading the Case-Shiller report was kind of like reading the poetry of Sylvia Plath. You really wanted to go have a stiff drink after looking at the Case-Shiller report. For most of the last 4 years, it's been nothing but good news. Case in point, DFW home prices, according to the Case-Shiller people, have been up at least 8% every month for 23 consecutive months. We don't have the final December numbers yet from Case-Shiller. They're on about a 60-day stagger, but it'll be 24. Bottom line, however you measure it, prices have done nothing but go up in the Metroplex. Here are some charts that you can find by going to the Texas A&M Real Estate Center website. that give you kind of a year-over-year comparison, 2014, 15, and 16. And what you'll see if you look at these charts, for Dallas, Fort Worth, Arlington, the whole metropolitan statistical area overall, just about every month, 2016, was better than the previous year or two. The one notable exception is July. If you look at July of 2015, that will go down as one of the busiest months we've ever seen in this housing market. So we didn't do better in July, but pretty much every other month, 2016 eclipsed the prior 2 years for the Metroplex as a whole. For Dallas County, excuse me, for Collin County, and then you can look at the numbers for Denton, and just because it really was a factor, Tarrant County, you see 2 really strong years in a row, but particularly a very strong 2016. So all across the Metroplex, from White Settlement to Wiley, it was an amazing year for the DFW home market. Here are some specific Netris zones that'll kind of give you the flavor of what it looked like. Now, how many of you get the Netris stats sent by one of our marketing reps every month? I know there are a few of you here who do. If it's something that interests you, you might get with me and get me a card after class. What I do is I take the numbers from all of the Netris reporting zones that we track and I put them on kind of a little schematic. This is an example. Where you see yellow, that's an increase. Where you see a slightly different color, kind of that weird blue or green or purple, that's a bigger increase. When I was doing these schematics in 2009, the page was basically white. Now, everywhere you look, the numbers are up. They're either up in terms of sale or dollar volume, but they're definitely up in terms of median and average sale price. And as you will see, in some areas, they're up significantly. Take example, look at Salina. Almost an 11% increase in sales, a 33% increase in dollar volume, 26% increase in median sale price. Does that sound like a pretty good market? Doesn't look bad, does it? Let's look at Allen. Sales are down 46.7%, dollar volume off 43%. Those aren't happy numbers, are they? Does that mean Allen is no longer a desirable market? No, what does it mean?
People aren't moving.
Bingo! People love Allen so much they're not selling their houses, so there just aren't as many houses to be sold. And there are a lot of other markets where you're going to see pretty much the same dynamic. But by and large, you take a look at these numbers, positive across the board. And where sales are down, usually it's more like Flower Mound. They're off about 1% because of lack of inventory, but the prices are going up and so the dollar volume does the same. Frisco, very solid market, 4% growth in sales, nearly 11% in price growth, 7% increase in your median sale price. Here's page 2 with a few additional numbers. Garland, really good market right now because again, there's still some inventory there. You know who else is cleaning up in Garland right now? Investors. Cash-rich investors are going in, buying properties, rehabbing and flipping. It is Chip and Joanna world over there.
I saw that at Oak Cliff.
Yeah, Oak Cliff, perfect example. Yeah, North Oak Cliff in particular. You know, ever go down and drive around in North Oak Cliff, the Kessler Park area? Yeah, my orthopedic surgeon's down there, so I have to go down there periodically, and I'm always amazed at how quickly it is turning over and changing. And that's just one of several areas where you see that dynamic. You can see other markets that are really rocking along. Lucas had a tremendous year. McKinney off a little bit because of no inventory, but the numbers otherwise are good. Plano is kind of the poster boy for there's no inventory, so sales were down a little bit. But right below that, you see Prosper had another remarkable year. Richardson is a good example of a market that had sort of a brief moment in the sun. People like the older homes, they like being closer into Dallas proper, and as a result, anything that was affordable there has been gobbled up. Other parts of Richardson are gentrifying, and I expect these numbers to shift back a little bit, but that's another example of where if there's nothing for sale, not much is going to sell, but you're still going to see price appreciation everywhere you go. So throughout the Netris reporting zone, the numbers are very positive. Additional things to factor in. The foreign national buyer, very big player in our market. They accounted for more than $10 billion in home sales across Texas last year. A lot of that landed here in the Metroplex, but the big thing is a lot of it was cash. These were not finance transactions. They were quick and easy close. They aren't all owner occupied. A lot of them are being held as investments, but that's okay. They're sales that count. The rising tide lifts all boats. The thing that people are concerned about when it comes to the investment of foreign nationals is, will that continue? Will economic policy lead that to go away? Case in point, you look at what the dollar has done in the last 60 days. It's a lot stronger against just about every other form of currency out there. And there are some who suggest that maybe that means we won't see as many foreign dollars coming in and investing in real estate, but there are a lot of other people who will tell you that more than anything, what the foreign national investor is looking for is stability. And even if there are some fluctuations on the currency rates, this is still a better place to put your money than speculative investments elsewhere. So the expectation is that we will continue to see strong traffic from foreign national buyers. The luxury market is something you have to pay attention to as well. When we talk about the luxury market, we mean homes that are priced at more than $1 million. Now, a lot of us are not playing in that sandbox. We hope to one day, maybe we will be in a year or two, but it's not reality for most of us in this business. Even so, this matters to you. It matters to you for a couple of reasons. First is that relative factor of perception. The people who are out there spending more than $1 million on homes aren't going to do that unless they feel pretty safe about putting their money into that kind of an investment. With this many $1 million plus homes selling, it tells you the high net worth individual feels good about the relative health of our real estate market and the value of their property as an investment. It also tells you that the banks are feeling good about the immediate short-term economic picture, or else there wouldn't be liquidity for purchases of homes at over $1 million. The fact is, for the fourth year in a row, the luxury sector has gone absolutely crazy. If you go back 4 years, we have seen increases of 23%, 16%, and 12% in the sale of $1 million homes. Last year, it was only 8%, so it was a smaller percentage number. But based on what had come before, when you look at the numbers, we still sold more $1 million plus properties than we ever had. That continues to be a very positive and vibrant sector. It's the smallest in terms of the relative percentage of transactions reported with interest. It's fewer than 2% of the deals out there, but we see more of them every year because the people who can spend that much on their homes are feeling pretty good about where we are. Builders. We keep waiting for builders to kind of help fill the inventory gap that we all know exists. The difficulties that they have we will talk about later, but even with those difficulties, builders had their best year since the recession started in 2007. They didn't quite hit 30,000 starts for the year. They ended up at about 29,600, but still the best year they've had, and the fourth quarter in particular was very strong. Both starts and sales up in the fourth quarter, giving them momentum going into 2017. The apartment sector is something else that we need to talk about. Now, I know a lot of you are thinking, why do I care about apartments? I don't get paid when somebody leases an apartment, right? Well, here's the thing. When lots of people are leasing apartments, we eventually reach the point where there aren't a lot of apartments left, right? And when that happens, what do rents do? They go up, and when rents go up, say by about 4 or 5%, what do people in apartments do? They get out. So you have to pay attention to what's going on in the apartment sector. Last year was the busiest year in the history of the Metroplex for net apartment leasing, over 27,000 units leased. The previous high was 19,000 back in the 80s. So that tells you how crazy apartment world is right now, and we all know why. Everybody's moving here and nobody can find a home, so they are finding their way into apartments and looking for a home when they've got time later on. The demand for apartment communities is incredible. As a result, we have 50,000 units that are or will be under construction at different points in 2017. The rents are something of an issue. Average rents increased by about 5% in the Metroplex overall last year, but it really depended on where you were looking. Let's say, for example, you have a job with a company down in Dallas. You're looking for a nice apartment in a mature community south of 635. How many of those are there? There aren't just an awful lot in areas where you can really make a decent commute, where you really want to be. And as a result, rents went up by way more than 5% in those areas. On the other hand, if you're looking up here where it seems like you can't swing a dead cat without hitting a new apartment community, rent increases weren't quite as high, but the bottom line, they still went up every year. So again, we pay attention to the apartment sector because there's a lot of pent-up demand there. We'll talk about that later in the program. We don't normally think of the apartment community as a good place to be plying our trade when we're realtors, but there's a lot of people who are in there now that don't want to be, and it's not going to take much to push them out. Pay attention to what's going on in the apartment sector. So, with all the good news, time to talk about the bad news. And last year when we stood here, we had one problem to talk about. Today we have two. The first one, obviously, is the matter of inventory. It is still really bad, as in god-awful. And frankly, calling it that doesn't go far enough. I tried to find a really good descriptive way to summarize how awful the inventory situation is. And what I came up with this. I think it might be worse than having to watch a whole afternoon of Katherine Heigl films on the Lifetime TV network.
The men agree with you.
Yeah, the men will agree. Hey, but so will some of the women. Because when I asked who was like the worst actors in the world, polling some of the women in the company, that name came up a bunch. But the bottom line, however you want to phrase it, inventory in the Metroplex is at an all-time low. Kind of like political discourse in this country. Hey, inventory sitting at 16,400 listings for the whole reporting area. That's less than a 2-month supply. Now, Real Estate Economics 101. How do we define a market at equilibrium? How many months?
6.
Yeah, we're nowhere near 6. But, just for a point of fact, does anybody know the last time we had a 6-month inventory level in Collin County?
99.
Not quite that bad, but you're talking at least 2007 or so. So it's been a long time since we've had a market at equilibrium, but it's been really consistently bad for an awfully long time. In Dallas County, going into the year, we had about 4,400 listings. That's a 1.7-month supply. Collin County, we're looking at 1.8. We really got it good here. And in Denton County, 2,580. That's again a 1.7-month supply. But here's the thing. When you talk about inventory, we can throw out numbers. We've got a 2-month supply. Whoop-de-doo. You got to look at it specifically along the lines of price points. If I'm looking for something at 750,000, lots of inventory out there. Pretty much everywhere you go, there's going to be at least 4 months, and in many cases, you will find 6 months inventory at the high end and the extreme high end. On the other hand, let's say we're looking in Frisco for something at 250,000. We don't need to time that by months. We can time that with a stopwatch is what we can do. And just to give an example, my wife, who is a Keller agent who works out of the Plano office, recently found a listing in Plano that was about a $275,000 listing. How many minutes had passed before multiple offers were on the table? About 45, and I kid you not, she wound up with 14 offers on it. So if you have anything in the sweet spot, it's going to go immediately. As a result, there's not much there. The inventory is covered on this report that I do, and in most cases, there's just nothing anywhere. So inventory continues to be a big problem, and that much anticipated flood of new listings that Jonathan Smoke and others were telling us about, well, keep on waiting, because I don't see that coming anytime soon. The second problem that we need to focus on, if only because we need to put it in perspective, is the question of affordability. Right now, the big concern that many people who analyze our market have is that prices have gone up so much that our market is now too expensive. And I think we know for certain kinds of buyers in certain parts of the Metroplex, this is undeniably true. I used the example a little bit ago about the young family looking for their first home. They're not likely to find much in Plano. There's less in Plano than there is in Frisco, not much in Frisco. I mean, there are a lot of markets where there is no inventory, prices have continued to go up, and so certain kinds of buyers really are rather priced out. But we find that there are still places for them to go, which has really been the beauty of our market in recent years. And the second thing that you have to keep in mind is that affordability as a matter of concept is really all relative. Even with the price increases that we've seen, we are nowhere near the most expensive housing markets in the country. To give you an example, there is a study that was done by an organization called HSH.com that ran in the Dallas Morning News in the third quarter sometime last year. What HSH does is they study housing prices and income levels, and they come up with a formula that tells you what you need to be making as an annual salary to buy the median sale priced home in all of the largest markets in the country. The national average, you need to make about $52,000 a year. Here in Dallas, even with all the price increases we've seen, we still only need a $55,000 annual salary to buy that median sale price home. All right, you want to go live in South Lake, you got to make more than $55,000. But as a matter of general affordability, still a lot of room here for a lot of folks. And then you've got to compare it to other markets like San Francisco. You want to buy the median sale price home in San Francisco, let's just assume that you do. You need to be earning $162,000. Does anybody have a thought or a visual on the median sale priced home in San Francisco? I think it would be something like the hippie commune my mother lived in the 1960s before I was born. It's not probably anywhere we would want to live. So if we're talking about something habitable in San Francisco, you need to be earning considerably more than that. You may need a 7-figure income for what a lot of us would like. So bottom line, affordability, very much relative. Another thing that you can look at, there is an article on the Texas A&M Real Estate Center website done by two gentlemen named Torres and Day that talk about the notion of personal income per capita relative to increases in housing prices. And what Torres and Day tell us is that when what we call the triangle metros, the big markets in Texas, Dallas, Houston, San Antonio, Austin, housing prices have gone up, but personal income per capita has actually gone up more. Bottom line, a lot of the jobs that we've created here in Texas are good. They're well-paying jobs, and people are still able to afford the housing. They do know things are tighter in Dallas than probably any of the other markets, but still not nearly as bad as a lot of people will tell you. I think if you're going to worry about affordability, what you need to worry about is the impact of rising interest rates. What will that do to affordability? One of the things that has made our market so attractive is not only were we undervalued, historically speaking, but the policy was free money, so it was not hard to qualify for a lot of mortgage and get a lot of house. But what we've seen since December is mortgage rates have gone up on average about a point, and then they ticked back down. But we're still a little higher than we were, say, November of last year, say December of last year. And what that does is takes a bigger bite out of affordability than the escalation of prices. Let's say you have a $350,000 mortgage and you take it out in December. You were getting around 3 1/8 as your interest rate. If you're doing that same mortgage today, you're probably going to be 4 1/8 to 4 1/4. The impact of that 1 point increase on a $350,000 mortgage is $200 a month on your payment. If you're talking about a 15-year fixed, it's not as bad, but it's still a $100 increase. So the increase in interest rates is definitely something we need to watch, because I think that's going to have more of an impact on affordability than just the increase in prices themselves. But when you put the two together, it's kind of a pincher effect, and it may definitely crimp things for us here going forward. So we've covered 2016. What do we have to look forward to in the year ahead? Well, I always start by talking about the national economy, because look, we all know we're very blessed to be in Texas. We have one of the strongest regional economies you're going to see everywhere, but you always have to worry about what the knuckleheads in Washington are going to do, because frequently they can screw things up for us without us even knowing it. Bottom line though, this year anyway, it looks like things will be relatively stable. We do have a new economic direction. The previous administration's economic outlook basically was this: rather than unleashing business by lowering taxes and doing away with regulations, they chose to stimulate the economy by keeping interest rates low, thinking that if it were less expensive for individuals and businesses to borrow money, that they would do so and then inject that money back into the economy. And they tried it for 8 years, but it really never worked terribly well. We never saw economic growth of 3% or better in any of the last 8 years. It tended to be fairly tepid. It was usually in that 1 to 2 range. And anytime they talked about raising interest rates, what did the stock market do? They panicked because the investors recognized, even though nobody was saying it in so many words, that these guys didn't have any other ideas. If interest rates weren't low and money wasn't free, they didn't have any other way to kickstart the economy. So every time they even hinted at raising interest rates at the Fed level, everybody in New York panicked. We know, though, that that's going to be a little different. One of the trade-offs is this: we will see higher interest rates. How much higher, we don't know. The federal funds rate went from 0.13 to 0.28 in December. The most recent pronouncement from the Open Market Committee is that they will leave rates alone for the time being. Most people expect that we will see the federal funds rate increased once or twice more this year. But what will that mean for mortgage rates? Most people are saying that it won't be a significant increase this year. We may see mortgage rates solidly in the 4s by the end of the year and into the 5s in 2018, and that comes from Lawrence Yun, the head economist at the National Association of Realtors. But thus far, we haven't seen the concomitant increase in mortgage rates. Like I said, they went up to 4.5 in some cases early last month, but then they started trending back down. So mortgage rates may go up a little bit, but probably not enough to derail the momentum in the housing market. And the trade-off is that everyone expects that we will see stronger economic growth as the year goes on. Indeed, the Wall Street Journal survey of economists, which is a pretty good place to go if you want to have a sense of the direction of our economy, the Wall Street Journal survey is saying that we likely will see about 3% growth for the year and stronger numbers for 2018. So by and large, people seem to be fairly positive about the outlook of our economy. Job creation and wage growth are expected to be better by the fourth quarter. The job growth numbers actually have been pretty impressive. The last report shows unemployment down to 4.6%. Now, do I need to explain to everybody why the numbers we get on unemployment are basically a bunch of crap? Some of you know it, right? Here's the deal. There are several measures of unemployment that you can get by going to the website for the Bureau of Labor Statistics. There's the happy mouth garbage number that the news people report, which is currently 4.6%, but there's also a number called the U6 measurement. The U6 measurement takes all the people that are unemployed, and then all the people that are so unemployed that they've been out of work for like 100 weeks and they no longer qualify for benefits, and then all the people who are so unemployed that they've given up on finding a job. The number that the news media gives you doesn't count those people, because apparently they're just so unemployed we can't consider them unemployed. I guess we need another adjective for them. But bottom line is we got 92 million people sitting at home playing PlayStation who don't have jobs, and if you turn that into a real unemployment rate, we're closer to 10%. You like seeing it go from 4.8 to 4.6. We like seeing the job creation that we're starting to see, but dig a little deeper than the numbers that the media is giving you. You want to know the unemployment level is, go to the Bureau of Labor Statistics, check out that U6 measure. But however you slice it, job creation has already strengthened and is expected to get better as the year goes on. Consumer confidence has been a very big positive, and this really started during the last administration. In August, Americans felt very good about the immediate short-term direction of the economy and the job market. The confidence index was in the mid-90s in August. It went over 100 in November and December, and specifically because most American consumers feel good about the short-term direction of the economy. So I ask you, what does that mean translated to our industry? Well, if people are feeling better about the economy, they're going to be more likely to go out and spend 6 figures on a new home. Does that not follow? And right now, people are feeling very good about the economic direction. So bottom line, national economy shouldn't be a huge difference maker one way or another. The thing we have to watch for is trade. If we go to a full-blown trade war with Mexico, a $92 billion a year trade partner for the state of Texas, that could get dodgy. My belief, and several other people are saying the same thing, is that it will get headed off. There are a lot of diverse ideas between the governments of the two nations right now, and if that went to logical extremes, it could get bad. But by and large, it doesn't look like the federal government's going to do anything this year to screw up momentum. And in the meantime, here in Texas, we've got lots of good news. First off, we continue to lead the nation in in-migration new residents. On average, we get about 246,000 net new residents in the state of Texas every year. Focusing on our area, we get about 20,000 net residents in each of the 4 counties that make up the Metroplex: Denton, Collin, Dallas, and Tarrant. It translates, when you add it all up, to just about 200 new residents a day. How would you feel if you could have 200 new buyers leads every day? Do you think you could make a little money in this business? We aren't all going to get all of them. Some of us aren't going to get any of them. But the bottom line, there's a lot of business out there for realtors because people continue moving into the Metroplex. The second thing that we need to talk about, and the media is not talking about this, is what happens once people get here. They move in from wherever, but then where do they go? There's a lot of people shifting around within the Metroplex, and that creates opportunities for us. Just to give you an example, taking Dallas County between 2010 and 2014, they got 2,000 new residents from Chicago and 1,000 new residents from LA. Lots of in-migration, right? But in that same period, Dallas County lost 6,000 new residents to Tarrant County and 8,000 to Denton County. So yes, people are moving into Dallas County, but more are moving out to other areas of the Metroplex. So what that tells me is if I'm down in Dallas County, there may be opportunities as a listing agent, but it also tells me that if I'm newer or less veteran or working with buyers, there's opportunities for me in Denton and Tarrant County. But we need to give some thought to how that migration plays out once people have arrived here. It isn't getting talked about a lot, but it is a dynamic that really impacts our business. Job creation continues to be the big driver. Last year, we created approximately 124,000 non-farm jobs in North Texas. The projection this year is that we'll see another 120 to 145,000. The 145 is a figure from Jonathan Smoke, and since I bust on him for his price increases, then I'll just be, fair and honest. We got to maybe take this with a grain of salt as well. But however you look at it, a lot of people are predicting that job growth will continue. And here's the thing. When you look at job growth for our area, and this is more true for me speaking to those of you in this office than any place else that I might do this. We all know about Toyota, right? Toyota, maybe 8,000 new jobs, and actually when all is said and done, it's probably going to be closer to 10. But the thing that nobody's talking about is all of the other new jobs that are coming here in smaller blocks and groups because of Toyota. So yeah, Toyota's coming and bringing 10,000 jobs. How many jobs do you think were created by building that complex over there? And then let's talk about the companies that work with Toyota. The law firms, the CPAs, the advisors, the subcontractors, the parts distributors. There are so many other jobs that are moving to this area because they depend on Toyota, and if that's where Toyota is, that's where they've got to be too. It's a multiplier effect. And you can use the same dynamic not just with Toyota, but with State Farm, with Chase, with USAA, AT&T, whomever. Every one of the big companies that you hear about, there are hundreds and thousands of additional jobs coming here that no one's talking about, and all of it is pretty much right here within staggering distance. We're in a very, very good place to be selling real property right now. The demand is going to be big. The energy industry is one of those things that always makes people nervous, and I talked about this at the top of the program. The people from up north who don't really understand North Texas like to talk about how low oil prices were going to kill what we had going on here. The thing that a lot of them never understood, we're not an oil town. We never have been, we probably never will be. Fewer than 1% of our jobs were energy industry dependent. So when oil was shuffling along at $25 a barrel last year, which it was, how were we getting hurt? Well, we really weren't. Now though, OPEC has cried uncle. They were like putting no limitations on production for 2 years. They were trying to flood the market with cheap crude, hoping that they would kill off Texas shale producers, and it didn't happen. There were a few companies that were undercapitalized or imprudently managed that did bite the dust. Most of them learned from the 1980s and are still standing, and now oil is back at around $50 a barrel, stabilized a little bit higher. This is perfect for us. If oil's at about $75 a barrel, that's great for everybody. But if oil is at 50, it's better for us because we're not seeing job losses because of the low oil prices, but we are seeing $1.94 a gallon at racetrack. And so since we're paying less money to fuel up our SUVs, we've got more money to spend on margaritas, school clothes for the kids, or a new house. So the energy industry has actually become more of an asset to us than anything. And then finally, you have the matter of the millennials. I like to make fun of millennials, but you know what? That's my privilege because I'm an old man now. And I have a son that's a millennial, and I don't know a person on earth who needs to be made fun of more than my son. But the bottom line, the millennials are something we all need to take seriously in this industry because they have become the most active segment of home buyers in the country.
18 to 33?
18 to 34, 35, I've seen it defined in different ways, but that general area. Here's the thing, we think about millennials and we think, okay, they want to live in urban areas. They want to be near tattoo shops and bars, but that's not the case. They like being in suburban areas. When they couple up and have families, they want some place that offers them a sense of community. They spend more on their first home than their parents did, than a lot of us did or would. So they are a wonderful, wonderful target demographic if you are working with buyers. And as of September, almost half of the properties that went under contract in North Texas were purchased by, you guessed it, millennials. Now, the trade-off is this. They don't trade up as often as a lot of us do. The estimate always used to be that most people would be in their home 3 to 5 years before they move up. Millennials aren't as likely to do that. They're going to stay put for longer periods of time, but they're going to spend more when they do engage in real transactions. So it's a good sector to which you might want to start marketing, and they're definitely having an impact on our market here. Going forward, looking at a few other things that will impact our market. Apartment rents expected to increase by, again, 4 to 5%. But even if it doesn't go up that much, remember what I said earlier, I think apartments would be a good place for a lot of you newer agents to start marketing, explaining the value of home ownership to the people who live there. What you're gonna find is it's not a tough sell, because unlike 20 years ago, when everybody in an apartment was like the recent grad from North Texas living there with their stereo and their futon and their pet ferret and their smoking accessories, it's not really like that now. A lot of the people living in apartments came here with Toyota from California. They couldn't find a house when they got here, so reluctantly they went into an apartment. And it's that same dynamic. People come here from all over, can't find homes, they gotta have some place to do their laundry, so they get into an apartment, and a lot of them really want out. You will find a lot of pent-up demand, and if rents continue to go up by what we expect, you'll see more of it in the year to come. Home builders should top 32,000 new starts this year. That's good news. That will be their strongest year since the recession. The bad news, though, is it's not likely to do anything about the dent in inventory. The first reason is most of those starts won't be targeted at the lower price points. The reason is this: everything it takes to build a home today costs more than it did 10 years ago. Land, if you can find it, infrastructure to make the land builder ready, raw materials, labor, everything costs the builders more money, which means if we're talking about building a $250,000 home, our margin's not very good. So if we want to make money as a builder, we need to target different demographics. And so what builders are doing is they're aiming at the Californians that are coming here that are spending more money than the average first-time home buyer because they come here cash rich. They're targeting the baby boomers that are trading down. They're empty nesters now. They don't need 4,000 square feet in West Plano. They want something smaller, but they want amenities and a nice finish out. They're targeting these millennials we've talked about. They're going for a higher price point. So the median sale price on a new home sold in the Metroplex these days is more than $100,000 higher than the median sale price for a pre-owned. You're looking at about $350,000. Fewer than a quarter of the new homes being built in the Metroplex today are going to be priced at under $250,000. So builders should have a good year, but it's not likely that they're going to do much to relieve the inventory problems at the lower end. The other thing that builders are going to have to fight with this year, several articles in the Dallas Morning News, are problems with labor. There just aren't a lot of people employed in the construction trade. We had better than 1 million people building houses in the United States before the recession in 2007. Today, we are still at about 60% of that. There just aren't a lot of people around. One reason in Texas is because they can go to work for the oil companies. They can make more money in the Permian Basin or going to North Dakota than they can framing homes here in the Metroplex. And just to give you an example of how bad it can get, I was over in Midland earlier this year, and there was a new hotel being built, like a Hilton Garden Inn or something like that. The framing was up, but nothing more had been done, because in the middle of the night, one of the oil production companies had come and hired the crew and offered them more money. And that's the kind of thing that builders are facing. Another issue that will matter to builders is the matter of immigration reform. But here too, you gotta be careful what you read, because there are a lot of people weighing in on this that don't know what they're talking about. I read an article in USA Today back before New Year's, written by a typical person in Virginia who does not understand where we are, saying that anything that reduced the flow of illegal immigration into Texas would kill our housing market because there would be less demand. That's right, they're all coming over the border and buying $500,000 homes, aren't they? That's not where it's going to hurt us. If illegal immigration is reduced, what it's going to do is it's going to further cripple the builders, because that's going to lessen their supply of available labor. That's where USA Today missed the mark. But anything done in the way of immigration policy is going to have an impact on builders. They know they're going to have to pay people more, but if they do that, it jacks up costs, their margins are tighter, and there again, they elevate price points. So builders are caught in between. They want to help, but given the constraints that they face, very hard for them to do anything that will really have an impact on inventory. And that having been said, most people expect the inventory problems to ease slightly, but the expectation is that they will continue throughout the year. We're not likely to see it much better than 2 months anywhere in the Metroplex at any point in 2017. So with all that having been said, what do we think is going to happen this year? The first thing I would tell you, the higher interest rates that we see will have an impact, maybe not the impact that some of us are expecting. We have a lot of people who have to buy homes here. They're going to come here and buy homes, whether the rates are in the 3s or in the 4s or in the low 5s. Mr. and Mrs. Toyota executive moving here need houses. They won't be deterred because rents are a point higher. What it will do, I think, is probably limit trade-up purchases. If you've got a beautiful home in a nice neighborhood in Allen, like Twin Creeks or something, and you got in 4 years ago at around 3%, you see the home that's a little bigger, more expensive, a couple blocks over, you don't know that you want to buy it off on a 5% mortgage. When you're in where you are at 3, a lot of people won't trade up. But for the most part, it's not going to put a crimp in demand, because there will always be that many people that just really need to buy. Nationally, The expectation is that home sales will be up about 2.2% this year. Here in North Texas, the estimates are all over the map. I've seen some people saying flat. I've seen some people say that it may be as high as 7%, which is essentially what it was last year. Most of the estimates, and the ones that our company is relying on, put it in that 4 to 5% range. We're going to see more transactions by a decent number here in North Texas. Prices are, again, the wild card. We know they'll go up. The question is how much. CoreLogic is saying 4.7%. I'm saying that if the inventory situation doesn't get a lot better, we're going to see the same dynamic we've seen for 5 years now. Anything that goes on the market will have people fighting over it in no time, and that will put upward pressure on prices, meaning at the end of the year, we could very easily have another year of close to double-digit appreciation. For what it's worth, Zillow says 7.3%, but you know, that's Zillow, so do with that what you will. And then, of course, there's this. Because real estate is really easy, as all of you know or are finding out, and because HGTV tells us it's really easy, everybody you know is going to get into business with you. So that means more agents fighting for not more listings, which means that a lot of us are going to lose one or two here or there. It could be, again, the best year in the history of the market, but for a lot of us it isn't going to feel that way because we're not going to have as big a piece of the pie. At some point that'll correct, but it hasn't yet, and it's not likely to in 2017. So bottom line, this is one of those years that could be the best year in the history of the market. It could be the best year that a lot of you will ever have in your career. It won't be for everybody. It's just going to be a function of how you play it. My suggestion is to keep in mind the words of the vaunted and venerable Mike Brody, KW broker down in Plano, who says, this is the market we've waited for a lifetime. And he's absolutely right. The bottom line, it's not going to last forever, but we've probably got another 2 years of good crazy. We certainly should get one more year out of it. So my advice to all of you is enjoy it, don't completely trust it. If you have a good year this year, don't go spend all your money. Does that make sense?
Yes.
This isn't the year to go get the Range Rover, no matter how much you want one. This is the year to extend the lease on your nice Lexus or Mercedes and put a little money in the bank to plow back into your business when the rainy day comes. Does that make sense to everybody?
Yes.
Because guys, when it changes, it's going to change pretty quickly. I think this will be a very good year for us, but you always have to keep an eye over your shoulder. There's a lot of stupid and crazy out there. So with that, we'll take questions. I'll hang around and answer questions, but I want to thank you all for giving me the opportunity to come in. It's a pleasure to get the chance to work with you. Go have a great 2017 and have some pizza.